ESG investing is a growing trend in finance. ESG stands for environmental, social, and governance. It is a way of investing that considers more than just financial returns. ESG investors also care about a company's impact on the world. They want to invest in companies that are doing good for the environment, society, and have strong governance practices. ESG investing is about aligning your money with your values. It is about making a positive impact with your investments. This approach to investing is becoming increasingly popular. Investors are realizing that they can make a difference with their money. More and more investors are looking for ways to make a positive impact. ESG investing allows them to do just that. It is a way to grow your wealth and support a better future. ESG investing is not just a trend, it is a shift in how people think about investing. ESG investing focuses on three key areas: environmental, social, and governance. Each pillar represents a different aspect of a company's sustainability and ethical practices. Let's break down each pillar. Environmental E. This pillar focuses on a company's environmental impact. It includes factors like carbon emissions, resource use, and waste management. For example, a company that invests in renewable energy would score high on the environmental pillar. Another example is a company that reduces its water usage. Social S. This pillar looks at a company's social responsibility. It includes factors like labor practices, diversity and inclusion, and community engagement. A company that treats its workers fairly would score high on the social pillar. Another example is a company that promotes diversity in its workforce. Governance, G. This pillar focuses on a company's corporate governance practices. It includes factors like board diversity, executive compensation, and transparency. A company with a diverse board of directors would score high on the governance pillar. Another example is a company that is open about its business practices. ESG investing is gaining popularity rapidly. This is due to several factors. One factor is the increasing awareness of global challenges like climate change and social inequality. Investors are realizing that these issues pose financial risks as well. Another factor is the influence of millennials and Gen Z investors. These generations are more likely to consider ESG factors when making investment decisions. They are also more likely to invest in companies that align with their values. Furthermore, there is growing evidence that ESG investing can be profitable. Studies have shown that companies with strong ESG practices often outperform their peers financially. This is because ESG factors can be indicators of a company's long-term sustainability and resilience. Lastly, the regulatory landscape is evolving to support ESG investing. Governments around the world are implementing policies to encourage sustainable investing. This includes measures like requiring companies to disclose their ESG-related risks and opportunities. Section 4. Benefits of ESG investing. ESG investing offers numerous benefits for investors. These benefits go beyond just financial returns. They encompass a broader perspective on the impact of investments. Here are some key benefits. Alignment with personal values. ESG investing allows you to align your investments with your personal values. You can support companies working towards a more sustainable and equitable world. This can provide a sense of purpose and satisfaction that traditional investing may not offer. Potential for strong long-term returns. Companies with strong ESG practices are often better positioned for long-term success. They are more likely to adapt to changing regulations and consumer preferences. This can translate into stronger financial performance and higher returns for investors. Enhanced risk management. ESG factors can be indicators of a company's risk profile. Companies with poor environmental practices may face legal or reputational risks. Companies with weak governance may be more susceptible to corruption or mismanagement. By considering ESG factors, investors can identify and mitigate potential risks. Positive impact on the world. ESG investing goes beyond just making money. It allows you to use your investments to make a positive impact on the world. By supporting companies committed to sustainability and social responsibility, you are contributing to a better future. Section 5. Risks of ESG investing. While ESG investing offers many potential benefits, it's essential to be aware of the risks involved. Like any investment strategy, ESG investing comes with its own set of challenges. Limited standardization in ESG metrics. One challenge is the lack of standardization in ESG ratings and data. Different ESG rating agencies use different methodologies, making it difficult to compare companies consistently. This lack of standardization can create confusion for investors and make it challenging to evaluate companies effectively. Potential for lower diversification. ESG investing can sometimes lead to lower portfolio diversification, particularly if investors exclude specific sectors or industries based on ethical concerns. This concentration can increase the portfolio's risk as it becomes more susceptible to downturns in those specific sectors. Higher costs and fees. ESG funds and investment products can sometimes come with higher costs and fees compared to traditional investment options. This is because ESG research and analysis require specialized expertise and resources, which can translate into higher expense ratios for investors. Risk of greenwashing. Greenwashing occurs when companies exaggerate or misrepresent their ESG credentials to attract investors. It's crucial for investors to be diligent in their research and look beyond surface-level claims to ensure that companies are genuinely committed to ESG principles. Section 6. ESG investing strategies. There are various approaches to ESG investing. Each strategy comes with its own set of considerations. Investors can choose the approach that best aligns with their goals and values. Common ESG strategies include negative screening, positive screening, thematic investing, ESG integration, and impact investing. Negative screening excludes companies not meeting ESG criteria. Positive screening focuses on ESG leaders. Thematic investing targets specific ESG themes. ESG integration incorporates ESG factors into financial analysis. Impact investing aims for measurable positive impact. These strategies help align investments with values. Section 7. Getting started with ESG investing. Embarking on your ESG investing journey can be straightforward with a structured approach. Define your ESG priorities. Reflect on the environmental, social, and governance issues that matter most to you. Do you prioritize climate action, social justice, or ethical business practices? Research ESG investment options. Explore ESG-focused mutual funds, ETFs, stocks, and bonds. Utilize reputable ESG rating agencies and research platforms. Choose an ESG investment strategy. Select a strategy that aligns with your goals and values. Select a brokerage or platform. Choose one that supports ESG investing. Monitor and adjust. Regularly review your ESG portfolio. Stay informed about changes in the ESG landscape and new opportunities. Remember, ESG investing is a journey. Stay engaged and committed to aligning your investments with your values.